In the United States, we have voluntary compliance. Now, that's not to say that it is illegal not to file your taxes or not to pay your taxes, okay? But we do voluntary compliance in which we all voluntarily cooperate with the tax laws and file our taxes every year rather than making the government come get them from us. Does that make sense? So it's illegal not to do it, but it's voluntary to do it, sort of. It's.
So if we don't do it, they come after us, illegal. I mean, it's still legal if they have to come after us, as long as we give it.
Well, but if you don't pay it on time, there's all sorts, or file on time, there's penalties. Like, they usually, what ends up happening is they hit you monetarily. So, like, if you don't file your taxes on time, they charge a penalty. And if you don't pay them, like if you owe taxes and you don't pay them on time, there's penalties charged. And it can add up a lot really fast. So most people just go ahead and volunteer and pay it. And it is illegal not to file taxes. But the voluntary part comes from you filing them on your own rather than making them come after you for it. The Form 1040 is the long form. This is the form that anybody can use. There are no restrictions. Like, you know, with the 1040 EZ, there was that whole list of restrictions. There's no restrictions on the 1040. Everybody can use it for any possible income scenario that may exist. There are a bunch of additional forms that can be attached. We're going to go over Schedule A and B, but it goes all the way through to where they're using double letters and also numbers to name these forms. So there's hundreds of additional forms that could potentially need to be attached to a 1040, and that's why it's called the long form, because it can be like 100 pages long if somebody did indeed file every single form. Nobody ever files every single form because nobody has all of those possible scenarios. Because there's forms if you own a farm, there's certain forms, and if you are self-employed, there's certain forms, and if you work out of the country for part of the year, or if you work on an oil rig, or there's like different forms for like every possible income scenario, and nobody would have all of them in 1 year. That you'd be having to work at one different job every day. It'd be ridiculous. Okay, the Schedule B is the paper that you use to file to report your interest from a bank if it's over $1,500 in a year, or if you have more than one bank that's paying you interest. So if you have bank accounts at multiple banks, even if it's less than $1,500, you still use the Schedule B. And then the ordinary dividends, which are dividends that you're paid from owning stock, and you get a 1099 or 1098. It's usually a 1099 to show how much you earn from your dividends. That also goes on the Schedule B. Okay. Again, if you have more than one source. The Schedule B can only be attached to a 1040A or a 1040. It cannot be used with a 1040 EZ. So if you're filling out your taxes and you realize that you would have to use a Schedule B, you can't use the 1040 EZ anymore. You have to switch to the 1040A. Okay. Typically, the difference between a 1040A and a 1040, for most people, the difference is, am I itemizing my deductions or am I not itemizing my deductions? Usually if you're not itemizing, you'd use the 1040A, and if you're itemizing, you use the 1040. And then, of course, you have like those other scenarios I was talking about, like farm workers and people that worked out of the country. And 1040, you can't use a 1040A for that. Yeah, it has to be a 1040. And we're going to talk about that. Okay, so then we have deductions. Deductions lower your taxable income. There are multiple acceptable types of deductions. Medical expenses, so that includes doctors, dentists, eyewear, like eyeglasses, eye doctors. Okay, prescriptions, these are all medical expenses. Buying Tylenol at the Walgreens is not considered a medical expense. It has to be prescriptions. But you know, anywhere you get the prescriptions, you keep the receipts. Those are medical expenses. They can be deducted. Property tax. So if you own land or property and pay property tax, that's deductible. State and local taxes. That includes state and local income tax, or it includes sales tax. You have to pick one or the other. So you can keep every receipt for everything you buy for the entire year and add up all the sales tax and deduct it. Or if you live in a state that has a state income tax or local income taxes, you can deduct that. But it has to be one or the other. You can't deduct both. So you'd have to pick which one was more. Casualty and theft losses. Casualty is if there's damage to your home, like fire damage, flood damage, storm damage, anything like that, that's not covered by insurance. So anything that's over and above what the insurance pays for is a casualty loss. And then theft, same thing. If your car is stolen, let's say, and you owe $20,000 on it, but the insurance company only pays you 10, you can deduct the other 10. Okay? Or any thefts that aren't covered by insurance, like somebody breaks into your house and you don't have home, like let's say you're renting and you don't have renter's insurance and they steal a bunch of stuff, that is covered. You can deduct that. Moving expenses can be deducted. Now that's not the first and last and security deposit of the new house. You can't deduct that, but you can deduct movers, moving truck that you rented. Like if you have to move across country, you can deduct the expenses of the whole trip on the way there, like the gas and the hotel and all that. Business expenses. There are two kinds of business expenses that can be deducted. If you are an employee, non-reimbursed business expenses can be deducted. So union dues, if you had to travel for work and they didn't pay for it, that can be deducted. If you had to buy uniforms for your job as a requirement of your job and they're not paid for, that can be deducted, things like that. And then if you own your own business, of course, there's a whole bunch more business expenses that can be deducted. All of your supplies, your building, depreciation, I mean, the list goes on and on and on that one. We're not going to get into that. You cannot deduct your gas to and from work. You cannot deduct miles or gas to and from work unless, so you can't deduct your commute. But let's say you get to work and then your boss sends you across town to pick up something and bring it back. That's deductible. You just can't deduct driving to work and driving home from work. Does that make sense? Because the commute is considered part of your own expense, and then any traveling that you do for work, separate from driving to and from, is deductible. Does that make sense? Okay. Alimony paid. Divorced people earning alimony have to claim it as income. So, like if somebody sends me an alimony check, I have to claim it as income. But because I'm claiming it as income and paying taxes on it, that means the person that sent it to me doesn't have to pay taxes on it anymore, because I'm going to pay the taxes on it as my income. So it comes out of their income, so they can deduct alimony that they paid. Mortgage interest. You cannot deduct your mortgage payment, but you can deduct your interest on your mortgage, so the bank interest on the loan. Charity, so donations to charity, cash and items can be deducted, time cannot. So you can't say my time is worth $10 an hour and I volunteered for 20 hours and deduct. It doesn't work that way. It has to be money or physical objects. Job seeking expenses, so resume printing. If you had to go buy a new suit to go look for a job, that's a job seeking expense. If you had to travel to go look for a job, that's a job seeking expense. So those can be deducted. And then tax preparation fees, not this year's. So let's say it's April and I'm getting ready to do my taxes. I hire somebody and they charge me money. I can't deduct it right now, but I can deduct it next time because it's the year. All the taxes are all from the year before. So right now we're in 2015, so everything that was filed this year was all 2014 stuff. It all had to be from between January 1st and December 31st of 2014. So the tax prep fees from 2014 can be deducted in 2015. So you have to keep the receipts. Any questions about deductions? Okay. In order to do all these deductions, you have to fill out a Schedule A, and you're itemizing the deductions, and itemizing is listing. And the Schedule A is this paper right here, which allows you to calculate and list your deductions. Some of them you just list, and some of them have calculations that go along with it. For example, in 2012, and I don't know if the percentages have changed, but in 2012, you could only deduct 7.5% of your, 7.5% of your income. You could only deduct medical expenses over that. So if 7.5% of your income was $2,000, you could only deduct medical expenses that were more than $2,000. So you'd have to subtract $2,000 from them and then deduct the rest. And then with the job expenses, so that would be the moving, business, and tax preparation fees, those kind of things. Those are only for over 2% of your income. So they have to be more than 2% of your income for you to get any kind of a deduction. So, and we will talk about that more when we actually fill out the paper. Okay, tax credits is another way to reduce your taxes. The deductions get subtracted from your income. So they lower your income, which then lowers your taxes because you calculate the taxes from a lower income level. Tax credits lower your taxes because they get subtracted from the tax. So if your income is $10,000, you figure out the tax, then you take the tax credits and you subtract them from that, and you get a lower tax bill. The most common ones, child tax credit. So if you have kids, you get child tax credit. Earned income credit, you have to have a qualifying dependent, and you have to make under a certain amount of money based on your family size to receive that one. And then there's education credits, which are if you're in college, you get these education credits. And there's other kinds of credits. If we look on the back of the 1040, tax credits is this whole top section. Okay, there's foreign tax credit, child and dependent care expenses, retirement savings contribution, residential energy credits. So that's for, you know, that thing they say if you switch to energy efficient appliances, you can get like your taxes lowered. Those are tax credits. So there's a whole bunch of different ones that people can get. It's just you have to qualify for them. We're not going to go into every single one of those either because that's a lot to go into. But then you have tax avoidance and tax evasion. Both of them are avoiding paying taxes. One is legal, one is not. Tax avoidance is legal. This is when you use the deductions and the credits available to lower your tax bill. Perfectly fine to do that. To go and comb through every receipt you ever got for the whole year and try to maximize those deductions. Do that, definitely. Tax evasion is illegal. This is lying on your tax form, claiming deductions that you don't actually qualify for, claiming dependents you don't actually have, claiming tax credits you don't actually qualify for, lying about your income. All these things are tax evasion, and that's illegal. It's a felony. Not only do you go to jail, but you also owe lots and lots and lots and lots and lots of money at the end. So don't do that. Any questions on those? We're going to do taxes for Margaret and Brian O'Sullivan and their daughter, Carol. Okay, so first we're going to start by filling out their top of their tax form. So we have Brian and Margaret, and her last name is O'Sullivan. We have their social security numbers. No, we've been doing zeros before. Now we're doing X's. Okay, they have an address. So that would go there. They did not work in any foreign countries, so we don't have to fill that out. And they do not feel like donating to the presidential election campaign. Okay, they are married filing jointly. Okay, keep in mind again, single, you have married filing jointly, married filing separately, which we're not going to be filling these out, but don't forget head of household is single people with kids or dependents. So anybody that's single with a kid or dependent gets to file as head of household. And then qualifying widow or widower. So we have Brian and Margaret, and then they had Carol, their daughter. I'm going to assume that she has the same last name. She also has a social security number. She's their child. Okay, so we have 2 boxes for Margaret and Brian, and we have 1 box for Carol. Don't forget non-kids go down here, so like if it's somebody that cares for their parent, that person goes down here on the last line. So they're going to have 3 exemptions. What I'm going to go ahead and do right now is flip this over, and line 42 says exemptions. I'm just going to go ahead and write times 3 right there so we don't have to flip back over later because they have 3 exemptions. So it'll be on line 42. That we filled out their top section. Now we want to talk about their income. So we have that. Yeah, that looks like they work together. All right, if they had combined wages of $76,521, they have interest from 2 different banks, and they have stock dividends from 2 different stock companies, and Margaret won $300 in the lottery. Yes, you have to pay taxes on that. Okay, so bounce back and forth between these 2, but we have wages, salaries, and tips. Okay, that was their combined income of $76,521. So that goes right here. Now, if somebody has tip income on top of their wages, that gets added in also. So like if you're a waitress, that goes right here. Okay, taxable interest, attached Schedule B. We have 2 banks, and we're more than 1,500, so we have to attach the Schedule B. So pull out your Schedule B. We have Seaford Bank and Buffalo Bank, and those just get written on here. You don't have to do anything else other than write the name of the bank on these lines. Okay. So Seaford Bank and Buffalo Bank. Seaford Bank is 877. Buffalo Bank. Thank you. Oh, sorry, I lied. Seaford Bank is 812. Buffalo Bank is 877. Okay. So you list the banks. So just list banks, and then list the money, and then add it up. So I have 9, 8, 1689. Excludable interest on Series EE and U.S. savings bonds issued after 1989. If you have these type of bonds, you get interest on them, but you don't have to pay taxes on that because it's a U.S. savings bond. So you'd have to fill out another form. There's always another form. Okay, so we don't have any of that, and so then our total amount of bank interest is $16.89, which goes right here on line 8A. Okay. Now, any of the tax-exempt interest that they're talking about would have been listed right here on line 3. So any tax-exempt interest would get listed right here. So if you had anything on line 3, you'd put it in here. We don't have anything, so we don't put it on there. Ordinary dividends. These are our stock dividends. Again, we're going to have to fill out a Schedule B. We have 444 from GM and 1200 from Kodak. So back to our Schedule B. In this section, we just list GM and Kodak. We had 444 from GM and 1200 from Kodak, and they get totaled up. So as you can see, the Schedule B is a very simple form as far as tax forms go. You just list stuff and add it up. Now, we're going to go ahead before we switch back over, and we're going to talk about Part 3. Okay? You have to fill this out, whether it pertains to you or not. You have to fill it out because you're answering yes or no. So at any time, did you have financial interest in a bank account, basically, any kind of account in a foreign country? If you did, there's another form you'll have to fill out, but we did not. Okay, so see, if yes, you have to fill out this form here. Okay, so we didn't have to, so we don't have to. Then if you're required, you enter the name of the country. So I'm not required, so I'm just going to keep saying no. And then during 2013, did you receive a distribution from? Were you the grantor of, transferor to, or transfer to a foreign trust account? If yes, you have to file this other form. We were not, so you have to say no. You do have to fill out all the no's. Okay, that's really important. If you didn't have any foreign accounts and you're filling a Schedule B, you do just go through and check no's. Okay. If you did have foreign accounts, then of course you have to fill out these extra forms here. Okay. So our total for our dividends is $16.44. That goes right here. Qualified dividends, you would know if you had those. We're not going to worry about that. Schedule B is done. This form now gets put to the side to be submitted all together at the end, okay? But it's done for right now. All right, as we go down this list, taxable refunds, credits, or offset of state and local income taxes. We don't have to worry about that. We're in Florida. Alimony received. So here, remember I said you can deduct alimony if you paid it. If you received it, you have to claim it as income, so it would be listed here. Okay, business income if you own your own business. You have to fill out a Schedule C or CEZ, and the income gets listed here. Or loss if it's negative. If it's a loss, you put a negative number right there. Other gains or losses, business related again. Go there. You have capital gain and other gains or losses. So there's other forms. See, Schedule D, Form 4797, tons of forms that could be attached. Then you have, again, this is if you're retired. Okay, so those two lines are if you're retired. These 3 lines are for business owners. So you won't have to worry about those unless you own a business. You won't have to worry about these 2 until you're retired. Rental real estate, royalties, partnerships, S corporations, or trusts. So this is money that you've earned from owning property that you rented out, having royalties, which means you wrote a book or produced an album or did something artistic and you receive royalties. If you are a partner or a part of an S corporation and you received money from that, or if you own a trust or you get money from a trust. Those all go there and you have to attach the Schedule E. If you had farm income or loss, you attach the Schedule F, F for farm, easy to remember. If you received unemployment, that goes here. If you received Social Security benefits, so you're either disabled or retired. And then if you had any other income. Oh, well, look at this. Margaret won the lottery. Lottery, $300. Other income. So, you know how, do you guys remember the scandal several years ago when Oprah gave everybody in the audience cars? And then people were really mad because they had to claim it as income. And they were like really expensive cars. Do you hear about that? Well, I think they were like $15,000 or $20,000 cars. had to be claimed as income. So it added $15,000 or $20,000 to their income for the year. That had to be put right here. One car on Oprah value of the car. That's why people were really mad. Plus, they also had to pay the taxes to when they registered the car. So it cost those people a lot of money.
That's what I thought. That's why I thought that would that taxes.
You're paying registration taxes, but because you won it, it's income. Yeah. So anyway, that goes here. Now we add up everything in this section. So let me grab the handy dandy adding machine. That's what the first calculators were called, by the way, adding machines. Did in case you didn't know that. Okay, so their total income is $80,154. Yes. Let's look at the next. Oops. All right.
Put the total amount that I want and then the amount that I paid.
Yeah. All right. So Margaret teaches a night course at the college, and she has $133 in educator expenses. Do you guys remember the maximum that you can claim for as a teacher? I told you guys there was the maximum. $200 is the maximum. Okay, so we have that, and we have $3,009 in moving expenses. So let's go back to our tax form. Educator expenses. She had 133. So remember, the max is 200. Okay. You have certain business expenses. Can go here. You have to fill out another form. Health savings account deduction. Okay. If you have a flexible spending account or a health savings account and you put your own money into it, like it doesn't come out of your paycheck before taxes, that money is tax-free, so you can deduct it here. If your company takes it out before taxes, you can't put it here. Does that make sense? Because it already hasn't been taxed. But if you open your own account separately for health care, like it's a health account, like you open at a bank or something, then you can put that in here. And you attach a form. Okay, moving expenses. They had moving expenses of $3,009. And we're going to go ahead and pretend we filled out this form. Okay, but you have to attach a form. Everything is attach a form, attach a form, attach a form, attach a form, always. Okay, there's a deductible part of self-employment tax. You have self-employed plans, self-employed health insurance. If you're self-employed and you pay for health insurance, there's a portion of it that you can deduct. If you had to pay a penalty on early withdrawals of savings, that you can deduct that. If you paid alimony, that's where this gets deducted. IRA deductions, student loan interest. If you're paying back your student loans, you can deduct the interest. You'll get a 1098 from the bank for that. Tuition and fees. Let's see, did anybody have any tuition and fees? No, okay. So they didn't, but if they had tuition and fees, it would go right here. Those are the out-of-pocket ones. And then domestic productions activities deduction, that's like domestic production is you're actually making something in country. Okay, add these up. I don't feel like thinking, so 3142 goes right here. That's the sum of those two, and then I subtract that from my income. So I have 77012. That is my adjusted income. Questions so far? Let's flip it over. So we had $77.12 is their adjusted income. They were not born before 1948, nor are they blind. They're not itemizing on a separate return. Okay, and you have your choice of itemized deductions or standard deductions. So we're going to itemize our deductions. So we got to get our Schedule A. They had $18,800 in medical insurance, but they only paid 20% of the medical bills. Okay, so that means they paid 20%. So we're going to multiply 0.20 times 18,800. Okay. So they only actually paid $37.60. Okay. So when we come back to this page, our medical and dental expenses are $37.60. You can only claim what you actually paid out of pocket, not what the total was. So like, for example, my appendicitis, that hospital bill is $65,000, but my insurance covered all but 50 of it. I cannot claim $65,000 on my taxes as medical expenses because I did not pay that. I paid 50 bucks. Does that make sense? Okay. So that's why we get the $37.60. Then we have to take our income, which was $77.12, and put that right here. And we multiply it by 0.075. And that goes right here. If this is bigger than this, we subtract them, and you put the number here. If this is smaller than this, there's no point because it's negative. They cannot claim any medical expenses. Okay? So they don't get that deduction. In the next section, we have state income taxes and real estate taxes and mortgage interest. Okay, so that's the next two sections, interest and taxes. Taxes, they had state income tax. See what I said, you had to choose between income tax or sales tax. You can't pick both, so you pick which one you're going to use. We don't have state income tax, so you could only use sales tax in this state. But they had $32.98, and then they had real estate tax of $35.67. Okay, real estate tax is property tax. Okay, and then personal property taxes, car, boat, mobile home, things like that you pay taxes on. So technically, like when you buy a new car and all the taxes you pay on that can go here. Or not that, I'm sorry, your registration can go here. Other taxes, we're not going to get into all of those, but those go here. We add those together, and that's $68.65. You don't have to take into account the income on these. That's just a straight tax deduction. It's not compared to income. Then you have the interest that they paid, which was mortgage interest of $30.96. Mortgage interest goes here. Mortgage interest not reported to you. So if you have a 1098, or if you didn't receive a 1098 but you calculated your mortgage interest yourself, you have to put that on a different line. Points not reported to you on 1098. Points happen in a mortgage. We're not going to get into those. Mortgage insurance, not homeowner's insurance. There's two different kinds. There's homeowner's insurance, which protects the house and your belongings. Mortgage insurance protects your ability to pay the mortgage. So if you can't pay your mortgage due to you get laid off or you die, the mortgage insurance takes care of it. So you can deduct that insurance, but not homeowner's insurance. Okay. And investment interest, if you had to pay investment interest. Anyway, we add those up, and that goes right here. Then the next section is charitable contributions. Okay. If you donate more than $250 to any single entity, there's instructions you need to see, and there's another form you have to fill out. You can donate more than $250 in the year without having to worry about that, but if you donate more than $250 to any single company or single whatever, then you have to fill out another form. The O'Sullivans donated $987 to different charities. The highest amount they gave to any one was $100. So they don't have to fill out that form. We put the $987 here. This is cash. Other than cash or check, this is furniture, clothing, cars, boats. You know, they say donate your boat to charity, donate your car. So anything that's not cash, that's an item, goes on the next line. And again, if it's more than $250 value, you have to attach a form. They donated $450 worth of old clothes to different charities. The most they gave was $120, so they're fine. So $450 goes here. Gifts to charity is the only category where you're allowed to carry over from the previous year. So let's say I donated a bunch this year, but I didn't have enough to itemize my deductions this year. But next year I do have enough to itemize my deductions. I can take the gifts I put to charity this year and everything from next year and put them together. Charity is the only thing you're allowed to carry over 1 year. That's all. So we'll add those together, and it's $1437. Then we have casualty or theft losses, and you do have to attach another form. Again, we're not going to worry about filling out all these forms because that's a lot to fill out, but we're pretending that we filled it out. They had $9,230 worth of flood damage not covered by insurance. So that's on top of what their insurance paid for. Or they didn't have flood insurance, one of the two. So that goes there. Then we have unreimbursed employee expenses. That's the job travel, the union dues, things like that. He had $541 for work, travel, and $1439 in union dues and $2315 in tuition that is for employment. So that goes, all of those go on the same line. So we have to add them together. So 541 plus 1439 plus 2315. Helps if you hit the right button. So 4295 is their total on that. So that goes right here. And then they did not have any tax prep fees, so we don't have anything. We'd have tax prep fees if you have safe deposit box. You can, you know, those cost money, right? You can deduct that. Add those together. Take your income again. Multiply it by 0.02. Subtract these if this one's larger, which it is. So I take 4295 minus 15, 40, 24. And that's how much I can deduct. So medical and job-related expenses are income-based deductions. The rest of them are just straight deductions. Other miscellaneous deductions, there's a list in the instructions for this page. We're not going to go into that, but if you go online, you can find the instructions and you can see the whole list of things that are deductible. A big long list. So then you add up this whole column down the side. $23,412.76. Here's why it's nice to itemize deductions when you have this stuff to deduct. Your standard deduction is $11,900 if you're married filing jointly. They actually get to deduct $12,000 more than that. So that's why it's worth taking the time to do this form. So, itemized deductions go on line 40, and we are done with the Schedule A that gets set aside. Okay, we subtract these two. Oh, I added them, not subtracted them. And that brings their income down to $53,599.24. And then they have 3 exemptions. So you take 3,800 times 3, and you get 11,400. And you subtract again. And now their income has gone from the original $80,154 to $42,199. So they've almost halved their income for tax purposes. That's why this kind of stuff is good to do. So then you go to your handy dandy tax table and you find $42,199. 42,199, and their tax is 5,456. We're going to stop here, actually, and I'm going to push everything a day back. We're going to finish this tomorrow, and instead of reviewing tomorrow for the test on Wednesday, we'll finish this tomorrow, review on Wednesday for the test on Thursday. Okay, so for homework tonight, work on this packet. Don't work on anything from the original homework packet, just this. Okay, so yesterday we stopped here. The next line is alternative minimum tax. We're ignoring that. Add the lines together, and so our tax bill is $54.56. Now, if we go back to the notes, this is where we were yesterday. We finished the Schedule A, and we found the taxes. We did the 3,800 exemption. Now they pay for child care, so they get a tax credit of $780. That is child and dependent care expenses. So this goes here on line 48. Right there on line 48. They're not getting a foreign tax credit. The child and dependent care expenses, that form 2441 you do have to fill out, which we're pretending we fill all those out. Okay. Then we look, they don't get an education credit, but they do get that energy credit for 133. Residential energy credits, you attach another form. And we're going to add those two together and put that on line 54. 54. Yeah. So 780 plus 133 is 913. So that goes right here. And credits get subtracted from the tax. So 54.56 minus 913 means that they owe in taxes 45.43. I'm just going to double check. Yep, okay. Now, they weren't self-employed. They didn't have unreported Social Security and Medicare. There's no IRA tax. Household employment, that's if you're employed in a household. You can get a first-time home buyer credit if you're a first-time home buyer. Other taxes, so we add everything together and keep it at 4543. Now we need to go back and find their federal income tax withheld. So, oops. It's not in here, is it? Huh. Okay, well, we'll improvise. They had $75,000 in income originally, right? So we will multiply that by 20% because that's about average. And we'll say that there was $15,000 taken out on their W-2s because it wasn't in the problem. Okay, they earned too much money to get an earned income credit, and none of these other things will apply. We're not dealing with those. So we add up all of that, and it's 15,000, sorry. They had 15,000 taken out of their income because that was based on their actual earnings without deductions and everything. Their tax bill is 4543. So we take the 15,000 and subtract 4543, and they are owed a refund of 10,457. And that's the long form. And you can see as you go through this how almost every line says attach form this, attach form that, attach form this, attach form that. That's why this is the long form, because if any of these things apply to you, you have to attach another sheet of paper. So all of the ones that we filled out where it said attach this, attach that would all have had to been filled out too. So this is a lot of paperwork, but since we're ignoring that part of it and we're just doing the main form, hopefully it's not too bad. We're just doing the Schedule A and the Schedule Bs. So any questions on the long? Gloria's single. Her taxable income without deductions was $25,760. She reduced her income by $5,381, which is actually kind of silly because the standard deduction is $5,950. So it would have actually been better to take the standard deduction than this deduction, but Gloria apparently didn't realize that. So her new income is $20,379, and we're not going to use Schedule X. We'll use the tax table. So before taxes, if I look in the tax table at $25,760, or sorry, before deductions, at this, her tax would have been $3,431. Since she reduced to $20,379, her tax is $2,621. So if we subtract those, $812 saved.